Relative stability today on the North American markets, except for the Dow. But no one knows when the next blow could come. Let's talk about this with Brent Joyce. He's the Chief Investment Strategist and Managing Director, BMO Private Investment Counsel, Inc. Thanks for coming in today.
Good afternoon.
I do want to start talking first about Donald Trump, admonishing the Reserve Chair, the Federal Reserve Chair. And I'm wondering what you think of this conversation and whether or not it does play out on the markets.
It's not the first time he's done it. It's not the first time a president has done it, right? So there is some history to that relationship. The market reaction, it's pretty muted. We saw some turmoil in U.S. Treasury markets a week or so ago, and perhaps we can talk about that, but you would expect that kind of reaction today if anybody was paying attention. The rule of law in terms of the Fed chair's role, how it's codified, it's Congress's purview, is pretty clear cut. Jerome Powell's a lawyer, so he knows this. And the president tweets all kinds of things. So taking it pretty much in stride.
Okay. Yesterday, after Jerome Powell made his comments, there was some activity in the market where it had been a little bit quieter in the morning. So clearly, some people are paying attention and are concerned. But do you think it's just because everybody's on pins and needles at this point?
Absolutely.
Yeah.
It's an emotionally charged environment, whether it's in the currency market, the bond market, the stock market, because this is not a crisis it's not a crisis at all, quite frankly, but it's not a development that's coming internal to the economy. The dot-com bubble was overspending in tech, the GFC was overspending in housing. These things are internal to the economy. This is an exogenous shock, and so is COVID an exogenous shock, you could say, right? But that's an unknown, we didn't know anything about it. This is quite understood as to what's happening and what the outcomes might be. We just don't know where the rates and on who and when and how long it's going to last.
Let's talk a little bit about the Bank of Canada's decision to hold the rate, and then also laying out two different scenarios, right? Saying, well, we're not sure what's going to happen, so we're going to lay it out two different ways. Both involve recession, one a minor one a year-long recession. What did you think of the style, the way that they're doing this, their decision to move forward with these two different looks?
I thought it was quite courageous. We had similar reports from some bellwether companies as well in their earnings calls, laying out
an A and B.
And sort of bookending it for folks. Here's where we see maybe the best case scenario or the least bad scenario in many cases. And here's where we think things might be if we go through with everything that might have been announced, a number of weeks ago. And so I think the bank has done a good job there. It's what we do when we're trying to do asset mix, is we probability weight a variety of scenarios and then position accordingly. The bank has been traditionally, here's our base case, but it's not unusual for them to talk about some scenarios, and they've just sort of used that as the base case today. I think it's a wise choice.
But what do you do with that as an investor, right? You're looking for specific guidance, specific numbers, that have a way forward. However you want to read them, you want something specific to look at. What do you think investors are thinking in this climate when there are so many scenarios being laid out before them?
Yeah, again, I think it's an honest approach by the Bank of Canada given the uncertainties that we face. What it allows us to do as investors is to get a sense of what their response would be given certain outcomes. And so that is about as much certainty as I think we can ask for, that it gives us a sense that they're not giving up on the inflation piece. It is certainly their mandate. But they have also intimated, and so has the Fed, that should things deteriorate rapidly, they will look through that and they will respond and they will support the economy. So it's reassuring on that basis. Now we're all data dependent, as they have been for quite some time, and we can sort of extrapolate and say, well, if the data starts to fall this way, we can expect this response. If the data starts to fall the other way, we can expect this other response. And there is some constructive use to that.
You've been tracking the American dollar through some of this. We'll pull up that chart in a moment. And I'm just wondering if you can tell me what you've been seeing. What does that look like from your view?
Yeah, I mentioned it's an emotional environment. There's a lot of drama, a lot of hyperbole, a lot of exaggeration, I would say. And so the decline of the U.S. dollar and the U.S. dollar losing its status as the reserve currency, you look at a longer chart of the U.S. dollar, and it's still very, very strong. You look at even just the last 6 months, a year, and all we have erased from the U.S. dollar in the last 3-5 weeks is what we put into the US dollar in November when we had the Trump bump. So we had a Trump bump, a Trump slump, and there's lots of reasons we can talk about why that is, but it is not indicative to me that there is some massive change, huge deterioration in the US dollar that is worthy of language saying it's losing its reserve currency status.
You don't think it's going that way?
I do not see that way at all. No,
okay.
No. And I would say that the data supports that.
I think people are waiting for some more positive news from Donald Trump on deregulation, on sort of the plus sides for the Americans as opposed to the trade war, which maybe he thought was going to bring a plus side that has really kind of decimated the markets for the start of the year. And do you think that's coming?
There has to be a mathematical recalibration from we talk about it as being spinach, then dessert, all right? And so the spinach is the tariffs, and the dessert is the tax cuts and the deregulation. So that got, the good stuff got priced in post-election through December into early January, and we obviously got ahead of ourselves. We have no good stuff to rely on today of any concrete promises, and we certainly have lots that we can focus on and uncertainty and flip-flops and move fast and break things mentality on the part of the U.S. administration. So you got two things there. Elevated uncertainty needs to be accounted for. Market's going to sell off on that. And now the math on what earnings may or may not be, and here's where we have all those various scenarios, but they're all being chopped at least, even with just the uncertainty that's been put through now. I think the market response in the entirety, if you think about where we are year to date or where we are from October of last year, is pretty reasonable given the dampening growth that we might see, how margins might be hit, demand destruction from tariffs, things of that nature. It's orderly, it's painful, but it's not in free fall.
Okay, let's talk about bond recovery this week. After what happened last week, what have you noticed? What are you seeing there?
Stability.
Okay.
One of the things that shocks tend to do is they tend to exacerbate existing underlying trends. Work from home was a thing before COVID, and now COVID just accelerated that. The U.S. 10-year bond yield has been rising for many, many years, and there's three components to that. Inflation piece, a real growth piece, real economic growth, and then there's this thing that's kind of nebulous called the term premium. And the term premium has been in a structural decline for decades. Some of that's QE, some of that is lack of alternatives in Europe and elsewhere. But that has changed 5 years ago.
Okay.
And so some of what we're seeing just in the last few weeks is normalization of that component. It's not, again, anything that looks disorderly to me. A lot of talk about Liz Truss moment for the U.S.
Yep.
That was a move of almost doubling long bond yields for the U.K. We're talking about 0.5%.
Got it. I do have to leave the conversation there. I'm out of time. But Brent, thanks for coming in. I appreciate that.
Pleasure. Good to see you.